Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, founder and publisher of The Daily Gold. And if you want to follow along with Jordan's work, we'll put a link to The Daily Gold down below. You just click on that, takes you over to his site. And Jordan, it's always great to get you on the show just to get your take on the markets, on the technicals, how different markets are interacting with one another. And let's kick it off with just a technical look at gold. All things considered, gold's been holding up pretty well, just under $2,000 here as we record today on Thursday, around 1992. What do you make of the price action in the yellow metal?
Yeah, it's pretty good. We had this strong rebound up to major resistance at 2000. It's major resistance on the weekly and monthly charts. We're coming up on the monthly close, I think next Monday or Tuesday. So that will be significant. But gold has predictably, after last week at hitting 2,000 on Friday, came back a little bit Friday. So far this week, the action, it's been consolidating bullishly, in my opinion. I'd prefer to see it continue to consolidate for a couple more weeks. But, markets don't always do what you like or act how you expect them to act. So we'll see. I mean, there's still, I think the all-time closing high is at 2070. And so there's some resistance at, I'm just looking here, 2050 or so. So if gold was able to surpass the resistance around 2000, you could see it climb to 2050 or 2070. And then, maybe at that point it pulls back to 2000 or so. I mean, I'm just thinking off the top of my head. Now, looking at support, there is really strong support now at, 1915, 1920, that area, as well as 1940. I think, and the low this week, I'm just looking, was about 1965. So as long as gold holds above, I want to say 1940, 1945, then, whatever this consolidation or correction is in terms of its time length or the pattern, if it holds above that level, 1940, 1945, then you have to think there's going to be a bullish outcome. So things are looking pretty good, and gold is also doing well in real terms, which I know we'll talk about. So even after this sharp rebound to 2000, it looks pretty good.
It really does, and especially considering we still have seen high rates and a high dollar. You would think that'd be a pressure, but a lot of times gold's been moving in tandem with the dollar and even in tandem with rates. So pretty resilient for the yellow metal. But when you look at silver and the mining stocks, they've done okay, but a lot of people have voiced their opinion on the interwebs that there's just not as much oomph in the mining stocks as one would expect, even despite this move in gold. How does that translate over to the technical picture you see in GDX or GDXJ?
I'm really not that focused on the technical picture on the miners. I mean, I will give it to you anyway. GDX rallied up to 30, which I think you can go back 10 years or so. That's a pretty significant resistance area. So predictably, it's pulling back. It probably needs gold to break above 2000 to clear 30. Same thing, looking at GDXJ, 35, 36, there's some resistance there, but, the frustration with how miners are acting and also juniors, this is incorporating a fundamental view, into my technical analysis. And it's clear that if we look at the cost pressures and the cost increases of the last 3 years, I mean, it has just been relentless. I mean, you could think about a year ago and think, oh, well, we've had this huge burst in inflation. There's not going to be that much more cost inflation after the fact. But I mean, there still has been. Like if you add another 5% or 6 or 7% after a big increase, that's still really hurting these companies. I mean, energy is a big cost. And I feel like if we're looking at CapEx for a lot of these projects, a couple of years ago, something that was 200 or 300 million to build, that's now 400 or 500 million to build. So you think about that, you think about operating projects, go back 3 years ago, if your all-in cost was 1,000 or 1,100, I mean, that's 14 or 1,500 now, and the gold price is basically around the same level. So, and if you look at silver at its peak was 28 to 29, and silver now is, 24. 23. So it's much, much lower. You have these huge cost increases. So, with all that being said, the reality is you're not going to see the miners and juniors and even silver as well. They're not going to lead, outperform, and leverage the gains in gold until we see gold break above 2,100 and move up to 22, 23, 2400, that kind of move. And maybe even, because if you get this breakout in gold, it goes to 22, 23, 24, maybe that comes back and retest 2100. I know I'm getting way ahead of myself, but after the retest, that's when the rest of the sector historically has been super ripe to really outperform gold. So, I mean, the really good news is gold is getting really close to 2100 and making that breakout. It's not that far off. But still, I wouldn't be surprised if the rest of the sector, it's going to take, I don't want to say a while, but I mean, it can take several months after the gold breakout or a few months after the breakout to really gain traction. So as long as gold is below 2100, and I mean, now it's still below 2000 right now, although it's really close. As long as we're in that context, how silver and the miners are acting, like it's just, to me, it's kind of a lagging indicator that it doesn't really matter. Gold in this major resistance is really, that's going to be the tell for everything.
Okay, so gold is the prime mover. We need to see a breakout in gold prices, but then even possibly a retest of the 2100 level once it passes it. And then when it moves up again the second time, that's really when people have the confidence to say, okay, the price assumptions we can use in economic studies now are going to be a lot better. The margins are going to be a lot better, because at that point, the metal's price will start outpacing some of the cost inputs and some of the inflation, and you'll see margin expansion instead of margin contraction. So we'll have to keep our eye on that. So let's just focus on gold then, since that's what's going to move the sector. You do a really good job, Jordan, when you're looking at different markets of doing intermarket analysis and looking at gold versus something like the commodity sector, gold versus currencies, gold versus equities. Any thoughts you have as far as gold in relation to other markets right now?
Well, last week, gold against foreign currencies, and the way to look at that is you're taking gold and you're dividing the opposite of the US dollar index. And actually, one way to look at that is gold multiplied by the US dollar index. So you're looking at gold without the impact of the dollar. And, that's why it's so important, because it's a way to evaluate gold in real terms. And it tends to lead the gold price in dollars, or the gold price in general. And so that hit a new all-time high at the end of last week. It's doing so again today. So that's a positive leading indicator for gold. Even with all this dollar strength, gold is holding up really well and performing pretty well. And so that's a really, really good sign. In addition to that, gold against the stock market, I mean, geez, I've been talking about that for almost a decade now. Hugely significant for gold and secular bull markets in gold. And I mean, that's been the huge problem over the last 4 or 5 years. And looking at that ratio now, today it's closing at a 5-month high, and closing just below 0.48. And there is like 2 to 3 year resistance around 0.50. So if gold were to continue to outperform the stock market over the coming months and surpass that previous high, that ratio would be hitting a 3-year high. So gold is showing really good relative strength now against the stock market. If you would tell me it's going to continue over the next 3 or 4 months, then I would say, okay, well, gold's probably going to break out in that time frame. But with that being said, I mean, the stock market is getting pretty oversold. Sentiment is getting kind of bearish. I mean, the price action is not good. So you could get an oversold bounce in the stock market, or maybe even, a bearish rally for 2 or 3 months. And perhaps that would coincide with a rebound in bonds and a decline in long-term bond yields. So that is something I'm not quite sure how, at least, I haven't considered it yet, but I'm not quite sure how gold would act in that scenario. Again, if you get an oversold bounce in the stock market for a couple months, bonds are really rallying, yields are coming down. So I'm just not sure how that would impact gold. That could maybe prevent gold from breaking out for a few months. Just one thought. But, circling back, overall, it is really encouraging to see gold's recent performance against foreign currencies, as well as the stock market. That tells you that this move is real, and it probably is sustainable.
Well, and one point you've made in some of the videos you produce and some of the editorials you put out to your subscribers, Jordan, is that there is a lot more going on in this market, in the precious metal space, than just geopolitics, because it seems like for the last couple of weeks, that's all anybody has talked about. And that's all anybody's attributed any price action, not just in the precious metals, but in the general markets and the bond market and oil. Everybody's talking about the geopolitics. Obviously, they are having an effect, and obviously there is some different markets in motion from that. But you've made the point that when you're looking at some of these other markets, like markets in relation to one each other, and when you're looking at some of the technical levels, but also when you're looking at some of the macro drivers that are still there behind this, the financial side of things, there's a lot more going on than geopolitics. What do you think are the key things for investors to watch, maybe more on the macroeconomic side?
I would watch unemployment over the next couple months or quarter or two. Unemployment tends to be a lagging indicator, and it tends to act much differently when you're in an inflationary environment like we're in now versus what we had been in previous 20 or 30 years. Because if we start to see unemployment rise, that will be one change in the economy versus the last couple years. And to get into stagflation, that's really what's been missing. I mean, stagflation, you have rising unemployment, weak economic growth in a recession. And in the last couple years, you haven't been able to call it stagflation because we've still seen an increase in jobs and employment. The unemployment rate hasn't been going up. But if the unemployment rate over the next couple months, next quarter or two, starts to trend higher, number one, that can be a recession signal based on some models. And number two, the Fed they're definitely not going to hike if unemployment is rising. In fact, that tells them that they probably should consider cutting at some point. So you have those factors. And in the bigger picture, the real problem is that even though short term, the inflation statistics and the inflation rate, it's coming down, maybe it can get to 3%. Paul Krugman was taking a victory lap over this. But the problem is you have long-term bond yields. You have the 30-year and the 10-year that are trading around 5% at the end of a hiking cycle. And if you look at break-evens, another indicator of inflation, they were rebounding. I was looking at the 10-year break-even at the end of last week. It had bottomed at its 200-day moving average. It had moved up to a 4 or 5 month high. If you look at, there's an inflation expectations ETF. I think the symbol is RINF. Just pulling that up, that surpassed its 22 high in the last week or so. So the stagflation risk for next year is really rising. And that's going to benefit gold because, the Fed at some point, they may be forced to cut when, long-term inflation expectations are still a major problem. So that's how I see the macro situation playing out over the next 3 to 6 months, and how and why that's attracting more money into gold, even though you have dollar strength, you don't have a recession yet, you have real interest rates are fairly high. You do have those things, but when you're looking out 3, 6, 9 months into the future, it's going to be hard to avoid a really bullish situation for gold. And as we know, the market discounts things in advance. It looks forward. And so that's what the market is looking at, 6 to 9 months from now, the Fed being forced to cut, long-term inflation expectations being a problem. If you're in a recession, an election year, doesn't matter whether you're left or right or center, you're going to want to, pump more money in the economy. So you're going to get more fiscal on top of that, and then you have gold breaking out above 2,100, then it could really feed upon itself. So I don't mean to drone on forever, but I think the market may be starting to kind of sniff that out with respect to gold and what could be coming down the pike next year.
Well, Jordan, just building on that idea, and I like the way you laid it out there, but there would be people in the mainstream media that are not looking at it the same way you are, because they're looking at this rosy picture from the Atlanta Fed that we're going to have 5% GDP number tomorrow. Granted, we're recording this before we know what the GDP number will be, but it seems hard to believe it'll be that high. Maybe it'll be 3 or 4%, but they're looking at GDP growth. And when they look at the labor market or when they look at the consumer, they're still seeing strength. And so there's still a lot of those soft landing people out there that think we've avoided the recession. It is weird to see gold holding up so well with positive real rates. So you brought up the break evens there. Inflation has come down while interest rates have gone up. and we had a negative real rate environment, which is usually bullish for gold. Now we've got a real rate that is at the positive area, which we hadn't seen for a while, and yet gold is up near all-time highs. What do you make of all the countervailing trends here that are kind of a mess, honestly?
Yeah, well, I think you have to follow the market because the market is the best leading indicator. I think with respect to real interest rates, I can say that historically, gold usually leads real interest rates at major turning points. Now, gold peaked in the summer of 2020. Depending on the real interest rate that you use, that did not bottom until 3 to 6 months after the fact. And you could go back and you could look at, I mean, there's other points in the last 20 years, even in the 70s. I think there were a couple moves in gold, at least one move that began a long time before real interest rates. I mean, if you're just doing the simple calculation, one move began, I think, before real interest rates really started to decline. If you look at 2005 and that huge move in gold, gold moved up well before and broke out well before real interest rates started to come down. So real interest rates are the best indicator for gold. But when you're at key market turns, gold is going to lead that in both directions. And I think it isn't the entire issue, but looking at that and then looking at next year, we see that, again, long-term inflation expectations are a real problem, not so much in the short term, but the Fed, if growth declines, the Fed could be forced to cut at some point next year. And then in that scenario, real interest rates are going to come down aggressively. So I think that's part of, not the whole thing, but part of the story with respect to gold's relative strength. When we also look at long-term inflation expectations, again, we're talking about this rout in bonds, this disastrous sell-off in bonds. Bonds have started a secular bear market. The last time they started a secular bear market was in the mid to late 1960s. And the bond market as a whole is the biggest market in the world, led by the U.S. government bond market. So you have massive amounts of capital that have just been able to sit in bonds, do nothing for decades. And now they see that inflation is becoming a major problem. They're concerned about long-term inflation now. So some of that money, a lot of that money has been going into the stock market, but at the same time, some of that money has been going into gold. Like if you look at gold divided by bonds, another relationship, that's been going parabolic because bonds have been such a disaster in the last year or so. So the long term, looking out, 10, 20, 30 years, retirees, pension funds, who now they can't, they're seeing that there's this massive change in the bond market. Some of that money is going into gold. Not a lot, but when you think about how gigantic the bond market is, all it takes is a little bit of money. So I think those are a couple factors. And, if sovereign wealth funds and, foreign governments who have had money in China, they've had money in U.S. treasuries and they're selling, so they're probably putting a little bit of that in gold. There's probably some Chinese demand. I'm not big on that, but that's probably a factor. We know that central bank buying has really supported the market in the last couple of years. Central banks, they buy weakness. They don't buy strength or breakout. So that's really supported the market through the recent consolidation. And I think those factors right now explain why gold has been performing well, even though, you have strength in the dollar and, real interest rates being high. And in addition to that, I will mention the stock market weakness. I think that's also a big factor because I think if we saw, I'm just pulling up the S&P. So it closed today, 4186. If we saw that 45 or 4600, I think gold would be maybe $100 lower. So the recent decline in the stock market, I think, and the rout in bonds, the breakout in 10 and 30-year yields is a big cause in that. I think that is also helped gold. I think if the stock market, again, I think if it were at 45 or 4,600, I think gold would be lower. So it's not just any one or two things. There's really a handful of things that are at work right now.
Okay. Well, those are some good thoughts for people to consider and some good correlations between different markets for people to keep their eye on. So I appreciate you sharing that with us, Jordan. Again, if people like getting Jordan's thoughts, definitely click on the link below. It takes you over to the Daily Gold. And Jordan, we'll be out of town next week at the New Orleans Investment Conference, but we will touch base with you in 2 more weeks and look forward to getting your thoughts then. Thanks for being a guest on the KE Report.
My pleasure. Thank you.